Real estate investing is one of the only types of investments that appreciates in value, generates consistent cash flow, and reduces your taxes all at the same time. The IRS grants real estate investors more tax breaks than almost any other group of people. But as a licensed CPA, I have learned that many people do not know how to actually get started with real estate investing in the first place to reap those tax benefits. So I am making this video as a guide to show you how you can build tax-free wealth through real estate investing, while also revealing the little known techniques that the ultra wealthy use to generate explosive results. So let's go ahead and jump right in. Okay, so if you are considering investing into real estate, you need to carefully decide what type of real estate you want to invest in, how you will actually invest into those properties, and 3, the tax implications of those investments. So let's break this down, starting with what real estate investing actually is and what it isn't. So buying a personal residence is generally not considered real estate investing, although it may be a wise financial decision. But if you instead rented that residence, even if it was just a portion of it, then it will be considered a rental or investment property, or that portion would be, opening the door for you to take advantage of many tax breaks. And there are many different types of properties that you can invest in. Within residential real estate, there's things like single family rentals, like standalone houses, multi-family properties like duplexes, triplexes, or small apartment buildings. There's vacation rentals, Section 8 rentals, and other forms of residential rental properties. But then there's also commercial real estate, like retail buildings, office buildings, parking lots, garages, storage units, warehouses, and other business use property. There's also real estate development projects that you can invest in, like new ground up developments that build properties from scratch, or simple fix and flip projects where you buy properties, fix them up, and sell them. Essentially, any type of real estate you use for investment purposes, where you are renting, flipping, or developing properties to turn a profit, typically qualifies as real estate investing. But how you invest into those ventures is arguably more important than what you actually invest in, because this will determine your level of control, your participation, and overall tax treatment from your investments, which will greatly impact how you build wealth with this. And as a CPA, I see a lot of people make mistakes here that end up costing them more in the future. So let's break this down. Okay, so on the highest level, there are 2 ways you can invest into real estate, either as a passive investor, or B, an active investor. Now, when you invest as a passive investor, I want you to envision yourself giving your hard-earned money, and in many cases, the control and decision-making power over your investments to someone else, such as a fund manager or real estate syndicator. You might invest into real estate syndications, trust, or crowd-funded deals where someone else is essentially managing the property, making the decisions, and running the show on your behalf. The advantages of this is that this would allow you to earn a return on your money or investment without having to manage anything yourself. And you still receive tax benefits through things like depreciation in most cases. So what could go wrong? Well, there are some major risks here to consider. For starters, you are trusting a third party typically to stick with whatever plan they pitch to you. And believe me, even good deals can go south with bad management. I have personally invested into several syndication funds, and while some went well, I have seen deals fall apart due to poor operators, bad financial decisions they made, or just misaligned incentives. And here's the kicker: when things do go south, you have almost zero control. You usually can't decide when the property sells, when distributions get paid, or how the property is managed. And the biggest thing you have to consider is the tax trap for passive investors, because the tax benefits of passive real estate are not always usable for some people. And this catches many people by surprise, so let me explain. The major tax benefits of real estate is that these investors usually take these big depreciation deductions that create losses that they can use on their tax returns. But under IRS rules, those losses are considered passive losses. And passive losses cannot offset active income, like your W-2 income or business income, for example. They could only offset other passive income, like rental income that you may have, royalty income, or income from other passive investments. And even if you own, control, and manage your own rental property, the associated income or loss is still considered passive by default, especially if it is a long-term rental rental property. But the key phrase here is by default. There are very specific exceptions to this rule, but most people are unaware of it. So let's talk about it. In general, to get the most out of passive real estate investments from a tax perspective, you would need to either A, have passive income to offset, like rental income, dividends, or interest, or B, you would need to turn your passive loss into an active loss, which is legally possible thanks to several provisions in the tax code. So let's talk about what those tax provisions actually are, like exception 1, the real estate professional tax status. By simply qualifying for this tax status, the IRS will allow your rental losses to be treated as active losses, which you can then use to offset your active income and pay less taxes. Now, to qualify for this, you must work at least 750 hours per year in real estate activities, spend more time in real estate than you do in any other profession, and you also must materially participate in the management of your properties. A lot of people think that they have to have a real estate license in order to qualify for this, but you don't. This status is all about the amount of time you spend managing your properties and your participation in it. But even if you do not qualify for this, you may also want to consider exception number 2, the short-term rental loophole. So a lot of people do not know this, but the IRS considers short-term rentals to be a business activity, automatically qualifying any rental losses you have in those activities to be active losses from a tax perspective. The IRS considers a rental to be short-term when the average guest stay is 7 days or less, and you must also participate in the operations of that activity. But what about long-term rental properties? Well, even though you may own and manage a long-term rental, it is still considered passive income according to IRS rules. The only way to turn long-term rental income into active income would be to either A, qualify for the real estate professional status, B, convert it to a short-term rental property like we just mentioned, or C, which most tax professionals don't even know about, is exception 3, place the property into a C corporation. So look, all of the passive versus active income stuff does not apply to C corporations. The C Corp treats all income and losses it receives the same, and it is effectively blind to these rules altogether, which means if you own passive investment property in a C Corp and earn active income in a C Corp, you can still use those passive losses against your active income without meeting any other criteria here. You don't have to be a real estate professional. You don't have to have short-term rental property. You just have to place the property in a C corporation. Now, with that said, C corporations are highly complex entities and are subject to many other forms of taxes and rules that you need to know about before you actually do this. And those rules are so in-depth, I would have to save that for another video. So if you want to learn more about that, just comment C Corp in the comments below. Or if you want a tax plan that is guaranteed to reduce your taxes, just apply to work with my CPA firm today at mycpacoach.com.